I find a lot of stocks that seem to have very strong fundamentals, and in today's video, I want to bring 3 of them to your attention. Now, to be clear, I do not own these stocks as of right now, but I want to show you why I think they look attractive and some of the key metrics I look for when I am analyzing new stocks. So in today's video, we are going to cover 3 seemingly high quality stocks that have more than 100x shareholder value. Before we get into this video though, I just want to say thank you to everyone who has ordered a copy of my book, The Fundamentals of Investing on Amazon. It's continuing to get some pretty incredible reviews, and thank you to everyone who has taken the time to leave a review as well. Leaving a review on Amazon really helps the book get in front of more readers, and I really appreciate it. So if you have purchased a copy and you have the time, then please consider leaving my book a review on Amazon. I'd really appreciate it, and I am just thrilled that so many of you are enjoying it. But with that being said, let's hop into the 3 stocks that are currently on my watch list. All right, so the first business here is Comfort Systems USA with the ticker symbol FIX. Now, if we take a look at this business's historical stock price performance, it was a $2.55 stock back in 2001, and it is almost $248 today. So this stock has almost 100x'd over the past 24 years. Comfort Systems is a mechanical and electrical contracting company. It's a very simple business to understand, and that's basically what the entire business does. Now, I've also noticed that it does have a stock unlock insight score of 4.27, which is pretty dang high. I don't typically see stocks with this high of stock unlock insight scores. So let's go and take a look at the insights and see why they could be so good. So right away, we can see that this business does have a dividend score of 4.20. The dividends per share have increased by 67% over the past year. And over the past 5 years, the dividend has grown by about 23% annually. So this is very much so a dividend growth stock. It also looks like they do not pay out a large amount of their free cash flow as a dividend, with only about 7% of the free cash flow paid out. So the dividend does look like it is very safe as well. Now, if we take a look at its financial health, it does have a score of 3.5. Its current ratio is 1, which is average. Everything there is good. It does have some intangibles, which maybe is because the company does some acquisitions, and then it gets some intangibles or goodwill on its balance sheet. However, it does look like the business is also buying back shares a little bit, and its debt to EBITDA ratio is very low at 0.1. So there's not a lot of debt on this balance sheet. Now, if we take a look at its growth score, it is a perfect 5.0. This business has increased its revenue by 28% over the past year. Gross profits are increasing, operating income is increasing, operating cash flow is up 200%. Free cash flow is up 231%. So this business's revenue is growing, but in addition to its revenue growing, it's also growing its profits, which is what creates shareholder value, as I discuss in my book. So I love to see the profits growing with the overall revenue. Now, if we scroll down to the profitability, it is a 3.2. Gross margin is kind of low. Free cash flow margin is about 10.4. So it just overall looks like the profitability for this business is average. It is a contracting business, so the margins are a little bit lower, because, it's not like a software business with a 80% gross margin or anything like that, but this is still just average. Now, the management score here is a 4.70. Stock-based compensation is only 0.25% of revenue, and I absolutely love to see this. As you guys know on my channel, I love businesses with low stock-based compensation because it means that the business is not diluting its shareholders to pay its insiders. And when there is a low amount of stock-based compensation, there is typically a higher incentive or alignment between the shareholders of the business and the management as well, at least what I've noticed in my own holdings. We can also see that stock-based compensation as a percentage of free cash flow is only 2.4%, which is very low, and that is good to see. ROIC is also 28%, which is incredible, and the business has massively outperformed the S&P 500 over the past 5 years. So the management of this business looks like they are doing an incredible job and keeping that stock-based compensation low. All right, so now let's go and take a deeper look at its financials, and let's head over to its income statement. Now, this is really interesting to me because the business does seem like it had its revenue kind of stagnate from about 2008 all the way out to about 2014. The revenue didn't really grow for about 6 years. However, since 2010, the revenue for this business has grown by about 500%, and it has now produced about $5 billion in trailing 12 months revenue, which is great to see. Now, if we head over to the cash flow statement and take a look at the operating cash flow, we can see that the operating cash flow is a little bit more cyclical, and during the financial crisis, or right after the financial crisis, it looks like the company's operating cash flow declined and went slightly negative in 2010, which is interesting to see. However, since this period, the business's operating cash flow has been growing massively, and it's been absolutely exploding over the past year. In the trailing 12 months, it has now produced about $600 million in operating cash flow. So the business is producing a record amount of profits right now, And this is what is guiding the stock up, is the increase in overall cash flows. Now, what I like to do is take a look at the cash flow statement and see what is the business doing with all of the cash flow that it is currently generating. And we can see right here that in the trailing 12 months, the business has paid off $341 million of debt. So that is where the majority of the cash flow is going, is to cleaning up the balance sheet. Additionally, it does pay $26 million in dividends, and it has been consistently buying back shares. So this is how the business creates shareholder value. It is lowering its debt, buying back shares, and paying out a dividend. So in my opinion, this business looks like it is pretty dang high quality with a very strong management team and a strong track record of creating shareholder value. Again, this stock is up roughly 100x over the past 24 years, which is absolutely incredible. Now, what's also interesting about this business is it is still trading for a price to free cash flow of only about 17 today, despite the stock hitting fresh all-time highs. This is a free cash flow yield of about 6%. Now, why I am hesitant and why I do not own this stock right now is because I don't know if it's just seeing a massive boost to its profitability, but if that is sustainable. I don't know if it is sustainable or if we are going to see some sort of slowdown like the business did from 2008 to 2010. Or in other words, I do not know if this is a cyclical business and if it has a long-term moat. I do suspect that it does have a long-term moat, but I don't know if we are at the top of a cycle right now or at the bottom of a cycle. And I would want to learn more about this business before I can gain that conviction and the overall long-term economics of it. So even though it is trading for what I believe is a low price to free cash flow today of about 17, I still don't have the conviction quite yet to end up purchasing this stock. But overall, this does look like a very high quality business, and it's one to definitely add to your own watch list and maybe do some more research on. All right, now let's move on to the next stock, which is NSSC, or NAPCO Security Technologies. This is a mid-cap business with a market capitalization today of about $1.66 billion. We can also see that back here in the year 2000, this was a 40-cent stock, and today it is worth about $44 a share. So this is another stock that has 100x shareholder value. NAPCO Security provides security products, so this is solely a security business, and it has been performing incredibly well over time. This business also has a stock unlock insight score of 4.53, which is even higher than Fix that we just took a look at. So let's take a look at NSSC as well. So we can see right here that the financial health score is 4.6. Its current ratio is 7. It's completely debt-free. It doesn't have a lot of intangible assets, and it has more cash than total liabilities by 283%. So taking a look at these metrics right here, I can already tell that this business has a pristine balance sheet. Again, it's debt-free and it has more cash than total liabilities. So if it wanted to, it could pay off all of its liabilities with its existing cash position. We can also see that its growth score is 4.88. Revenue grew 10% over the past year, but gross profits, operating income, net income, operating cash flows, and free cash flows are all growing very, very quickly. So the profitability of this business is growing, and that means that its overall margins look like they are expanding. Profitability score is also sitting at 4.2, has a 52% gross margin, a 24% net margin, and a 22% free cash flow margin. So this is actually a very profitable business as well. This is awesome to see because remember, it has a very strong balance sheet, and then in addition to it being a cash-rich company, it also has a lot of profits coming in the door. That suggests that this business is very financially sound and there's not a lot of financial risk with it at all. The management score is also sitting at a 4.9. There is low stock-based compensation as a percent of revenue, and stock-based compensation as a percent of free cash flow is only 3%. ROIC is also 35%, which is great to see. So the management looks like they are doing a great job on NSSC as well. So now let's go and take a look at its long-term financials here and see what's going on. So we can see that from about 2008 to about 2014, kind of like Fix, its revenue did not really grow. But from 2014 over the past decade, the revenue has been growing incredibly well. And the revenue is sitting at an all-time high right now, which is great to see. Now, if we go and take a look at its operating cash flow, we can see that there is this explosion of profits right now as well. And I imagine that this is why the stock is making new all-time highs. Now, what I do not like to see though, is that the operating cash flow for this business has been pretty dang cyclical. It's been going up and down from about 2009 all the way to 2019. So basically for a decade, its cash flows didn't really grow and they were just kind of stagnating. Then since 2019, it looks like the business has been able to grow its operating cash flows massively, which is a great thing to see. And then lastly, if we head over to the balance sheet, we can see that it does have $79 million in cash right now. And the cash position has been growing very nicely since about 2019. And then we can see that it only has $27 million of liabilities, So it does have a lot more cash than liabilities, and it does have a lot of net cash on the balance sheet, which again is great to see. Now, what I also love about this company is the president and CEO of the company owns about 10% of the shares. I love to see high insider ownership because it means that the person leading the business has aligned incentives with shareholders. And I've also noticed in my own investments that when there is high insider ownership, there does tend to be low stock-based compensation as well, because stock-based compensation, again, dilutes you as a shareholder. So if there's a lot of stock-based compensation going on and there's high insider ownership, then it's the insiders of the business who are diluting themselves. And that's not really what they want. So again, I typically find that when there is high insider ownership, there's also low stock-based compensation because the insiders want to protect and grow shareholder value, and that aligns their incentives with the public shareholders. So overall, NSSC has a phenomenal balance sheet, has a long track record of growth. The revenue is hitting all-time highs right now. Profits are absolutely exploding. There's high insider ownership. It's quite profitable, and there is low stock-based compensation. So there's a lot that I really like about this business. However, what I do not like about it right now is its price to free cash flow is still 42, which is a free cash flow yield of 2.4%. And remember, this business's profits are exploding right now and sitting at an all-time high. So basically what this business is pricing in today is for its profits to continue growing rapidly. Now, as we saw from about 2008 to 2018, its cash flows did not really grow. So my next steps in my analysis would try to be to figure out why did profits not grow from 2008 to 2018? And what is causing them to explode right now? Because I would want to know if something has changed with this business or if it is a little bit more of a cyclical one, and if its profits are going to start to decline in the future. And if its profits do start to decline in the future, then a free cash flow yield today of only 2.4% is not high enough to offset the future decline of profits. So those are the things that I would really want to find out, and those are the things that I would look for in the overall business. But you can clearly see that based on its fundamentals and its metrics, this does look like a very high quality business. All right, moving on to the third and final stock we're going to talk about today. This one's ticker is WINA, and the company is Winmark Corporation. This is also a mid-cap business with a market capitalization of about $1.4 billion today. Now, if we take a look, this stock was worth about $4 a share back in the year 2000, and it is worth about $392 today. So it is another business that has been able to 100x shareholder value over the past 24 years, which again is nothing short of incredible. Now, WINA does not have as high of an insight score, sitting at 3.86. So let's take a little bit of a look at what's going on here. Its dividend score is high at 4.6. Dividends are growing, payout ratios are low. That is great to see. Financial health is sitting at 3.14 though. It does have a good current ratio at 3.7. Low intangible assets, but its shares have increased over the past year, so that is definitely something to watch out for. Has done some slight dilution. Debt to EBITDA is average, and the business does have more cash than current liabilities. Now, if we take a look, its book value and tangible book value are negative though. So maybe this business does have a lot of debt on its balance sheet. We're going to have to take a little bit of a deeper look into that. Growth over the past year is also average at 3.13. Revenue is growing, but net income, operating cash flow, and free cash flow are all declining right now. Definitely things to watch out for. Profitability is a perfect 5 though. This business has a 95% gross margin. That is insane. Operating margin is 64% and a 53% free cash flow margin. That is more profitable than Airbnb, and that's more profitable than Google, and I believe even Microsoft. That is a ridiculously high free cash flow margin. That's actually very impressive. The management score is also at 4.0. There is a low amount of stock-based compensation going on, and the ROIC is very bad. So there's a few things that I might want to take a look at here. So let's go over to the financials and take a deeper look. All right, so let's take a look at this business's revenue over time. And we can see here that from 2005, it has grown its revenue from $26 million to about $84 million. So revenue has about 4x, 3 to 4x over the past about 18 years, which is good. It's not like insane growth though. So now let's take a look at its cash flows, and its operating cash flows are down year over year, and they're kind of stagnating right now. But we can clearly see that over time, this business's cash flows do uptrend. So I wonder if maybe something is going on right now where the profitability of the business is just And then they do need to do some operational efficiencies to get the margins back up. But there's not really a lot of red flags right there. The business is still growing. It is still producing millions of dollars in free cash flow, and its free cash flow is sitting at 44.6 million. So now let's head over to the insider tab here, and we can see that there is some pretty high insider ownership at this business as well. The number one insider right here is Ronald Olson with about 11.6% of the company owned, then Berman, who owns about 8.8%, then Meyer Investment Management at about 7.9%. So these two insiders right here almost own 20% of the company, and then this management business owns another 8%. So the top three holders own about 28% of the company, and two insiders do own about 20%, which is very high insider ownership as well. And again, we have another stock with very high insider ownership and low stock-based compensation. And I'm telling you, there is a trend there. I've definitely seen that trend. So my thoughts on this business is it does have a long track record of growth. Again, the stock has 100x'd since the year 2000. However, the price to free cash flow today is about 31, which is a free cash flow yield of about 3.24%. That is kind of a low free cash flow yield. It's getting better than the NSSC, but it's not quite where I would want it quite yet. Personally, I would want a little bit more of a margin of safety on a business like this, and I would also need to research more about what this business does, because I've read up on it slightly and I don't actually fully understand what the business does. It sounds like they have some sort of discount stores across the US or some sort of franchise, but they do have a 95% gross margin, which is insane. So it's worth diving into what this business does more. It's also worth diving into how is it going to continue growing its operating cash flows? Why are operating cash flows not growing with the revenue? And what is the long-term moat of this business? So those are some things that I would want to take a look at first. And then I would also want the price to free cash flow to come down a little bit more before I would become interested in it. If it got down to a price to free cash flow of 25, that would be around the area that I would get more interested in, because that would be a free cash flow yield of 4% on cost of the shares. And then of course, I would also want conviction that I believe this stock is going to grow over the long term. But based on its historical performance, based on the metrics we took a look at today, it does seem like it is a high quality business and definitely one to add to your own watch list, or one for you to research more in depth as well. So those are the three high quality stocks on my watch list that have 100x shareholder value over the past 24 years. And I hope that you learned something new from this video, or you gained a new investment idea of your own, or just an investment to research on your own as well. Also, a lot of the topics and concepts that we discussed in this video, I cover way more in depth in my book, The Fundamentals of Investing. So if you're someone who wants to learn more about how to identify high quality stocks like this that can compound shareholder wealth and create fantastic long-term investments, then seriously go and consider picking up a copy of my book, The Fundamentals of Investing, on Amazon. It is getting some incredible reviews from the readers, which I am absolutely honored by. And thank you so much again to everyone who has taken the time to leave a review and purchase the book. And seriously, if you are someone who wants to improve your own investing and become a better investor, then consider picking up a copy of my book. But that is going to wrap up the video for today, everyone. So thank you so much for watching. I truly do appreciate it. And I really hope to see you all again in my next video.